Hello there. Welcome to Commodities. Let's check in on that oil price. There are hopes, prospects of an end to the U.S. attacks on Iran. And of course, that could well lead to an end to Iran's attacks on its Gulf neighbors. Oil is down, not as much as you might expect. U.S. President Donald Trump indicating that he is ready for an end to this war. He is expected, last I heard, to address the American people at 9 p.m. Eastern Time. There are still threats, though, to world supply other than the Gulf of Hormuz. Reuters says oil and LNG shipments from Russia's Baltic export hubs, or two of them anyway, have been halted. And that's a week after Ukrainian drone attacks. This information came from Finland's border guard, which monitors the region's marine traffic, and apparently smoke still visible from Finland after those Ukrainian drone attacks. On Reuters calculating that as of last week, at least 40% of Russia's oil export capacity was at a halt. So obviously that story has been overshadowed by the disruption in oil flows from the Gulf. But oil taking a breather today. And just a reminder that President Trump does plan to make a speech, 9 p.m. Eastern Time was the latest time I saw. And he spoke to Reuters and he said that the U.S. has ensured Iran will not have nuclear arms. And he said Washington is ready to get out of the war, quote, pretty quickly, because we're not that far from May. Happy April 1st, everybody. And that's when U.S. driving season kicks in, and U.S. consumers won't be happy with a benchmark price of $4 US a gallon for gasoline. Checking in very quickly on the metals. We're going to have lots about metals on the show today. You can see gold edging higher, but it has dropped since America and Israel launched their attacks on Iran on February 28th, raising questions of why it hasn't acted as more of a safe haven in times of global turmoil. Vale Base Metals, this story from yesterday, is tempering expectations of an initial public offering in the near term. According to the chief financial officer at Vale, the parent company, the market isn't valuing it highly enough yet. That story was in the Globe and Mail. Niall McGee had that story. Vale Base Metals is 90% owned by Brazil-based Vale. And of course, its operations include copper and nickel right here in Canada. And another spill-off from the turmoil in the Gulf of Hormuz. We know aluminum, fuel products disrupted, sulfur, the world running short of that. Also, manufacturers of plastic products, including soda bottles, peanut butter jar, sandwich bags, just about everything made of plastic, are facing shortages of key components such as monoethylene glycol that they need. And so that's likely to push up packaging prices. Some other commodity stories we are on top of today. Shares of Ivanhoe Mines sliding about 12%. The miner has cut its production forecast for the flagship mine in the Democratic Republic of Congo. It now expects that facility to produce up to 330,000 tons a year. Now, this follows flooding that was caused by seismic activity. Suncor has identified 400,000 barrels per day of untapped production capacity at its existing facilities, which is enough to replace production at its Base Plant mine, which is expected to run out within a decade. Suncor says this will come from a proposed major expansion at its oil sands facility. The company also outlined an ambitious 3-year growth plan. We spoke with the CEO, Rich Kruger, on what that looks like going forward.
Yesterday, we put out a new 3-year plan that has a further $5 a barrel reduction in break-even, another 100,000 barrel a day growth in upstream production, and significantly material cash flow growth to our shareholders. So we think it is both ambitious and bold.
And you can watch that full interview with the Suncor CEO at our website, bnnbloomberg.ca. And more disruption in the Gulf. Bloomberg says a top aluminum producer in the Middle East has halted operations after its site was hit with Iranian missiles and drones. Emirates Global Aluminum lost power due to the strikes. And metal has solidified inside the smelting circuits, causing significant damage to the operations. Aluminum prices have jumped since Iran's attack on major facilities in the Middle East. And there's even talk the aluminum market could slide into something of a crisis. Let's get back to oil. It has cooled its jets a bit today, but it's still near $100 US a barrel. There are hopes for at least a ceasefire between Washington and Tehran. Our guest argues, though, that if the conflict and disruption continues through June, I mean, that would be 2 months, prices could hit $200 a barrel. Let's get more from Vikash Dwivedi, global energy strategist at Macquarie Group. Thank you very much indeed for joining us.
Thanks for having me on.
I know it's so hard to react day to day to this situation, but what's your read? Oil seems to have paused for now, but it's still pretty high, isn't it?
Yeah, it's still pretty high. Look, our base view is you have two parallel paths, right? They're related, but they can operate separately for long periods of time. You have the political path towards a ceasefire and an eventual peace deal. Mm-hmm. And then you've got the Strait of Hormuz. You know, one should lead to the other, but they can probably stay separate long enough to have very different outcomes, meaning we could simultaneously be de-escalating on the military front while the on the ground and on the water situation for oil is getting worse, getting tighter. That's how you can end up at some of these, and we agree, these are outrageous numbers, right? And but they become more realistic as time goes on. And one thing I want to make sure we understand, you know, when we say $200, it doesn't necessarily mean Brent futures contracts. We're talking about physical oil, you know, what's actually being bought and sold in Asia, for example. So we've already seen oil hit $170 a barrel in the physical market, you know, like the Oman grade is a good example. You know, the futures benchmarks like WTI and Brent, they should follow those physical grades. And given enough time, that gap will converge. It may not go to zero, but you'll see a big rally in the benchmarks if the physical ends up not being able to get solved.
That's interesting. Now, can you just clarify that for us? So if there is an end to the actual missile and drone attacks, there could still be disruption, you mean, as the industry scrambles to catch up?
Yeah, you know, we break that down. Your question brings up a good point. Like, we break it down into two segments, right? One is when will the ceasefire occur, and then, you know, will that allow the strait to reopen immediately? And if we just say yes, it will, then how long does it take after that to normalize the oil supply market? You know, we think at a minimum it would be a few weeks, like 6 weeks. Maybe a little bit longer. You have to still empty out a bunch of full tanks to give room for production to come back, right? So that you can use those tanks. You've got to reposition a lot of vessels that are, you know, not in the right spots. And then you have to wait a few more weeks until those newly loaded vessels arrive to their refining destinations in Asia, right? So you can really quickly consume 6 to 8 weeks doing that.
Wow.
It's the downstream that is more precarious. We don't know what the damage is in the refining sector in the Middle East. We know some of the facilities have taken hits. Our experience from Russia getting hit by Ukrainian drones is they've come back fairly quickly from attacks and damage to their facilities. You know, we're not sure here about the Middle East. So, you know, you might be able to get the crude market back to normal in a timely way, meaning not 6 months, but, you know, 6 weeks, 8 weeks. But the refining sector could take quite a bit longer.
That's interesting. Yeah, I guess it's such a vast global supply chain. It's so complex, 100 million barrels of oil every day.
Yeah, it really is. It's complex. There's grades considerations, like not every barrel of oil is the same. And the rerouting, and then, you know, we may get some surprises as different countries ramp their production back up. we're assuming because of the geology in the Middle East, the ramp up will be okay, but you never know, right? Like that's still left to be seen. So we want, we assume it'll be okay, but you don't want to take it for granted.
Tell us what about demand destruction here. You reckon that demand globally is the underlying demand for oil is strong. So at what point would we see significant destruction of demand?
Yeah, we think there may be some surprises that demand will not be destroyed as quickly by price. Diesel's a good example, right? Diesel demand is spread out over 8 billion people on Earth consuming things and transporting goods. So it's very diffuse, right? You might notice a slight increase in the various things we all buy, but not enough to create sticker shock, which also means, it probably won't destroy the demand. Gasoline is similar, although a lot more personal, right? Like a large percentage of people do have a daily or weekly interaction with the fuel pump. So if you get sticker shock there, you may curb some of your driving, but your baseload driving, which is commuting and kind of daily life activity, that's not as negotiable. You'll still do those. We think jet fuel will be the big one. Jet demand is more discretionary. People can choose not to fly. Yeah. And, we'll probably see a bigger hit there. We're already seeing a pretty massive hit in the Middle East, but global jet demand for the fuel has not dropped yet. We're a month into the war, and even though the Middle East has dropped quite a bit, globally, we're seeing it sort of flat right now, and you would have thought it would have fallen more by now.
Before we let you go, haven't got much time, I'm sorry. Is there any prospect of, with this volatility in oil, say there's an abrupt end to the disruption in the Strait of Hormuz, for example, could we see a plunge in oil? Could we even see a COVID-type plunge in oil down to, in theory, negative territory, as we saw during COVID?
Yeah, well, we think we could see a plunge. Probably not anything that would repeat the COVID, kind of price trajectory, but yeah, absolutely. Look, there's a scenario where a tremendous amount of the oil that's offline comes back quickly. The SPRs that are being released around the world are still going. The now unsanctioned floating storage keeps going, right? Like it may go longer than the 1 month. And suddenly you would go from being short oil to being massively long oil for a few months. And that could create the scenario that you described. Although going to negative prices, given all the other risk issues and kind of transitional availability of oil, that would be surprising.
That would be pretty extreme. Okay, I know. Vikash, thank you very much indeed. Vikash Dwivedi is Global Energy Strategist at Macquarie. Up next, gold. We have seen something of a rally for gold, but it has been a lunchbag letdown for those who thought it would act as a hedge during times of global turmoil. We're going to talk to Helen Amos of BMO after this. We've seen something of a rally in gold over the past few days, but of course it hasn't acted as much of a safety hedge since the war began on February 28th. And apparently central banks have been selling gold in some cases to support their currencies. You could, in theory, sell your gold holdings for US dollars and then use those US dollars to buy your own currency, propping it up. Let's get more from Helen Amos, Managing Director and Commodities Analyst at BMO Capital Markets. Helen, great to talk to you, and thanks very much indeed for joining us.
Good afternoon.
Part of your thesis on gold is that there's been such a spree among the central banks, and gold is a liquid asset, and some have chosen to sell it.
Yeah, that's right. I mean, as you said, gold didn't perhaps behave in the way that many people thought it would at the beginning of the Iran conflict. Now, we think there were liquidity issues going on, and not just central banks, but perhaps other more speculative investors as well. Like we have seen quite a lot of ETF outflows. But yeah, I mean, in the recent days, I would say it's been responding a lot more to its classic short-term drivers, rates, US dollar, so that traditional inverse correlation to those, that's been playing out quite well. And in turn, those are being driven largely by conflict news flow. And obviously, we've got a major catalyst coming up this evening with Trump's televised national address around the conflict.
And it's interesting, you talked about speculative assets. You say that's been measured by massive flows into ETFs. And the Economist, you may have seen this, arguing that that big run-up in gold over the past year and more may have been, in some ways, a meme trade, people just jumping aboard something that they thought had momentum.
Yeah, look, I wouldn't call it meme trade, but certainly we've pointed to the fact that ETF inflows were a big part of gold's move higher over the last 12 months. So when we did this regression analysis a few weeks ago, we found that gold's moved from 3,000 to 5,000. A lot of that was driven by ETF flows. A big part of ETF flows are retail investors. So we can't deny the fact that retail participation has been a big part of the story. And that's something I'm keeping a close eye on, because since the conflict, we've seen essentially continuous outflows. And we haven't yet seen a turnaround in that, even though we have seen a bit of a recovery in the price. Data that we saw yesterday was still another day of outflows. So I do want to see a bit of a reversal in that trend before I gain more conviction in the sustainability of this rally. And then you also point to moves by China, huge player in the global in the gold market, including Chinese retail investors. The Chinese regime apparently not happy about speculation and excessive buying of gold. That's right. So, Chinese retail investors have been a huge part of the story, as have, in other geographies as well. But one piece of news flow that caught our attention last week was a number of Chinese banks announced that they were tightening up their rules around something called gold accumulation products. Now, these are used by a lot of households as a form of savings products. So it's a way of households to build up gold holdings in small units. Now, in light of all the volatility, we've had big swings in the gold price since December, let's not forget, up and down. In light of that volatility, a number of banks are advising a lot of caution to their clients. And some of the banks are also limiting volumes, so trading volumes, or raising fees. So we're keeping a close eye on that. The other thing is that last week we did see, for the first time in about 7 weeks, quite a lot of ETF outflows from China. Now, up until this point, it was other regions that were really driving those outflows. So China was initially buying after the conflict. So look, not getting panicky about the situation or anything, but I think it's important to acknowledge when there are structural changes beneath the surface.
And just copper, we're tight for time. What is your outlook for copper here? I know the Gulf is distorting that market too, in the sense that sulfur supplies are running short and the copper industry needs that. But what is your outlook for copper in the next few months? Absolutely. So look, assuming that we get some sort of conflict ramp off in the next few weeks, we continue to stay quite constructive on copper. Now, we do think it's going to take a while for risk appetite to return to the same levels that we saw in, say, December, January, when we breached $13,000 a ton. But nevertheless, we do have copper prices returning to those sort of levels by the end of this year. And like we've discussed before, we're not quite so alarmed by the level of global inventory as others might be, because we're in this era of global fragmentation. We can't just stack up all regional inventory on top of each other in one block. And also on a days of consumption basis, it doesn't even look that high anyway. So we're still quite comfortable with the copper story. Helen, thank you very much. It's great to hear from you. Helen Amos, Managing Director and Commodities Analyst at BMO Capital Markets. Up next, Ivanhoe Mines taking a hit. The company yet again cutting production guidance. Slower ramp up than expected after problems at its huge Congo mine. We'll have more after the break. We mentioned this earlier, shares in Ivanhoe Mines, one of the companies backed by legendary mining financier Robert Friedland, taking a hit today. This ramp up of its huge mine in the Democratic Republic of Congo, huge copper producer, is taking longer than expected. Let's get more once again from Bloomberg's James Atwood. James, thank you very much indeed. Huge mine, hundreds of thousands of tons every year it produces. What is the ongoing problem, please?
Yeah, that's right. It's one of the already one of the biggest copper mines in the world and one of the fastest growing. Unfortunately, the growth is going to be a bit slower, quite a bit slower than previously thought. So the company did another report into its mine plan, into its scheduling, and that's coming after last year's seismic activity, which caused flooding. And they've come up with a considerably more conservative approach. So the idea is they're going to be doing some more development work at the front end, forsaking considerable production this year and next. Actually, next year is the big hit, and the idea being that they'll set themselves up for sort of stable, longer term supply.
It's amazing. I mean, obviously, they're mining on a vast scale. They hope to get up to 500,000 tons of copper every year in a year or two. But we were talking about this yesterday, weren't we? Problems in Chile as well at their giant mines, partly because of declining grades.
Yes, it's part of this ongoing story of supply side disappointment. So it just shows you how difficult it is to mine copper these days. Technically more difficult mines at deeper levels, and Kamoa-Kakula in the Congo was one of three sort of major disruptions last year. The other ones being Grasberg in Indonesia and El Teniente here in Chile. So it's part of a theme that is causing people to question whether supply can keep pace with demand. And in this case, the downgrade to production in here at Kamoa-Kakula in the Democratic Republic of the Congo is 23% lower for next year than it was previously forecast. So 23% at this mine is about 120,000 tons. So that's effectively removing an entire sort of mid to large size mine out of analyst equations. So it's a significant event.
Tell us, what about, we're very tight for time, but Chile, copper is vital to Chile. It's the most critical export. A lot of the industry state-owned. It's obviously politically important in Chile. Are people frustrated by the production problems, or is there public commentary on it?
Well, certainly frustrations around Codelco, which is the big state-owned company, and it accounts for a good size of the market, probably a little bit less than half. But so, it's a state-owned company, so there has been politics involved, and there has been a case of the country benefiting from Codelco's profit and probably not allowing the company to invest as much as it should have invested over the last few decades. That's resulted in a catch-up in terms of investments. It's now doing record $5 billion investments, and it's struggling.
James, we better leave it there. Thank you very much. That's Bloomberg's James Atwood. We're out of time on commodities. You've got the close coming your way next.